Okay, welcome to the November 29th edition of the Fats, Fuels, and Oils webinar. I hope everybody had a great holiday. I certainly appreciated the week off, but now we're back at it. So this week we're going to do our usual routine where we talk a little bit about what's going on in the feedstock markets, and then we'll go through our forecasts and what's going on specifically in the veg oils, and talk a little bit about what's going on in the fats and grease markets, and then we'll talk about what's going on in biodiesel, biomass-based diesel markets. All right, so over the last couple of weeks, there really hasn't been a significant change in the weather pattern in Argentina. And so there are still concerns about dryness in Argentina. We've talked about this a lot, so I'm not going to spend too much time covering it. I still feel like, the production in Brazil potentially could more than offset losses in Argentina, although I think that probably if the weather pattern doesn't change in Argentina, and if La Nina continues, probably there will start to be some concerns about southern Brazil as well, primarily because if you look at the impact of La Nina just broadly during the winter months in the northern hemisphere, sort of the circle of drier than normal conditions extends into southern Brazil. And so if the Argentine crop is going to suffer from dryness, then I think potentially you could also have the southern Brazil crop sort of have similar growing conditions. And that potentially could be a problem. So again, if the Brazilian crop is going to be close to what people expect right now, which is 150 million tons or so, a 5 million ton loss in Argentina, or maybe even a 10 million ton loss in Argentina, significant, but not going to send soybean prices up to record levels. If you get a 5 million ton reduction in Argentine production from current expectations around 50 million tons, and you get a 10 million ton reduction in Brazilian production, then you start to get to a spot where, again, probably not record prices, but certainly I think prices that are higher than where we are now. Now, one of the things that will have a huge impact on whether those losses are really significant or they are just kind of supportive of prices, but not really dire for the price outlook for soybeans and conversely soybean oil and then the rest of the feedstocks, is the demand for soybeans from China. And I think we've talked a little bit about this, where I think the analyst community assumed that as China came back from ASF, that it allowed them to convert their hog industry from an industry that had a significant amount of small farms where the pigs ate whatever was around, to a much more modern industry where pigs ate pre-made formulated feed that included a lot more soybean meal per animal than the smaller farms. And as a result of that, we all kind of assumed that Chinese soybean meal demand would be significantly higher than it has been. And while that's been the case in part, the growth and the rebound in imports hasn't been as strong as we all thought. And again, there's a couple reasons for this. One, maybe the transition hasn't happened as quickly as we all thought it would, or two, maybe the amount of soybean meal included in the rations isn't as much as we all thought it would be. Either way, Chinese soybean imports last year were lower than expectations, and if you just sort of look at the trend line, lower than the trend line would imply. And so this year, one of the big questions is, will Chinese soybean imports rebound? And so then if they do, that puts more pressure on South American production, because obviously US exports are going to be down, or I guess not obviously, US exports should be down, assuming that that the US crush is what we expect it to be, which is nearly 2.3 billion bushels, call it. There's a 50 million bushel difference, I think, or maybe a little bit less, between our forecast of 2.275 billion bushels in USDA's forecast. And so I think monitoring the Chinese crush, monthly Chinese crush, or even weekly Chinese crush, which you can do on the AgriCensus website, should provide some insight into how important the South American crop is going to be. And don't take this the wrong way, the South American crop is going to be important no matter what the Chinese demand is. It's just, again, it's sort of a difference between, okay, if we're going to have a smaller South American crop, does that mean that prices are well supported, or does that mean that prices are going to rise up to record levels? And so one of the things that I wanted to show you today, I wanted to dive a little bit deeper into first Chinese crush, and then talk a little bit about world crush demand, because what we've seen and talked a very little bit about, I think I've written more about it probably than we've talked about it, is that the Argentine crush has been significantly below last year. Now, part of that is because Argentina has had a couple years of below trendline yields, and so production has been down. But they also had the very successful soy dollar program, and Argentina typically carries relatively large inventories of soybeans because farmers use them as a hedge against inflation and economic uncertainty, I guess I would call it. And so even though they've had a couple of years of bad crops, they do have stocks that they can draw on. And if the demand were there for the products, then I think Argentine crush wouldn't slow down that much. Now, the fact that Argentine meal basis is substantially below US meal basis, I haven't looked in a couple of weeks, but it was at least $10 a ton lower than the US. But more starkly, Argentine soybean oil basis is 26 cents below the US basis at the Gulf. Now, you can say that, okay, well, the US basis reflects the domestic demand for soybean oil in the US, and that all makes sense. But even with the discount to the US, that still leaves Argentine soybean oil, if you just take the spread between palm oil and soybean oil in the futures market as an indication of what the cash market is. And I haven't looked, so I'm just going to make this leap of faith and kind of assume that it's roughly the same in the cash markets. If you take that spread, which now is about 35 cents, subtract out the 26 cents, then even Argentine soybean oil is still 9 cents above palm oil. That's much closer than the future spread, obviously, but it still is a little bit above the long-term average, which suggests that even though Argentine crush has slowed down, that the soybean oil market still seems well supplied, especially sort of relative to, or I'm sorry, the demand for soybean oil is stronger than the demand for palm oil, but palm oil is just sort of fallen off a cliff, and the world demand for soybean oil, even with basically no exports out of the US Gulf, is not strong enough to make that spread wider. And so I think that, and that's with the Argentine crush slowing down. I think that what that means is that that again, the importance of the growing conditions in South America is significant, but if you get Chinese crush not necessarily as strong and Argentine crush not necessarily as strong because the demand for products is not really there, then we can have a smaller crop in South America, and it doesn't necessarily imply significantly higher prices. Okay, so let me show you a couple of things here. So the first thing that I want to show you is this is Chinese crush margins. And I will say that this is a number that I pull from Reuters. So this isn't a calculation that I do. It's a number that I trust that Reuters has correct. We do the calculation in another place, but I didn't check it against this. And I assume even if the exact numbers don't agree, that the trend is similar. And I know for sure that at least during this summer, the trend has been similar. Now, this is a long run chart, and so this makes this sort of cramped a bit, but you can see that during the summer, Chinese crush margins just fell off a cliff and dropped to the lowest level that they've been in more than, or in about 10 years, roughly. But since then, since the middle of July or near the end of July, you've seen margins shoot straight up and are now certainly in the upper end of the historical range. That suggests that Chinese crushing activity probably picks up, and that Chinese demand for soybeans could be closer to current expectations, I think, than we would have thought if margins either didn't recover as much as they have, or if they were still negative. I think if they were still negative, I would probably be cutting my forecast for Chinese soybean imports pretty aggressively at this point. But given where they are, I think I'm pretty comfortable with where I am, which is, I think, 96 million tons, if I'm remembering that number correctly. It's somewhere right around there. All right, so the second thing that I wanted to show you, just sort of quickly, hopefully, this is crushing volumes in the major crushing countries. And so the US, Argentina, Brazil, and China. And then the black line is the prior year's total for the same month. And so the reason that I wanted to show this is because I thought, and I think based on what we've seen in Argentina, that if you looked at this chart, that the total this year would be significantly below the total that we saw last year. And you can see that while there are some gaps between the black line and the stacked bars, they're not huge and they're not necessarily persistent. And so you have some weakness early last year, and then in the spring of last year, and then in the summer when Chinese margins were horrible. But then you kind of recovered, and for September, at least based on our estimate for Brazil, it looks like we've exceeded it, and the main reason that we have is this huge jump in Chinese crush as Chinese crush margins have come back. Now, in October, there's a holiday And so Chinese crush dropped off a bit, and that's important for October, but I don't think that it is that important for the longer term. And you can see going forward that while we're not growing crush really significantly, which, you know, given what we expect out of the US, the growth in US crush and the at least theoretical growth in Chinese crush, maybe we kind of should be. That's not necessarily what we expect to happen, although we do expect some growth. The reason that that is the case is because you can see in here that Argentine crush is expected to remain relatively low, again, due in part to the fact that they had a drought before it starts to recover after next year's crop. And that's due partly to the fact that if they produce a 50 million ton crop, then they'll have more soybeans to crush, but also due to the fact that by the time that we get to spring, it will be surprising to me if Argentine soybean oil basis still is trading at a gap as large as it is to the Gulf right now. Now, of course, because of the demand for biofuel feedstocks at the in the US, there's going to be a gap between Gulf prices and Argentine prices. The Gulf basis and domestic and interior basis prices in the US need to rise to a level that will keep soybean oil supplies in the US and available for biofuel production. But if US exports, and that's mostly what I wrote about this week, if US soybean oil exports are significantly lower than they were last year, then there should be some corresponding economic incentive for Argentine crushers to crush enough to supply the market. And that incentive is going to be the Argentine crush margins are going to need to do a little bit, something similar to what we're going to see in the US, or what we expect to see in the US, which is because we expect the US crush to rise primarily on the strength in vegetable oil demand, and we expect that that ultimately crushers will need to match their crushing volumes with oil demand rather than meal demand. That means that the US is going to export more meal than we have historically. Now, I was talking to a colleague about exactly how much of the soybean meal is going to be exported. And his point was that whatever that number is, or whatever you think that number is, it's probably a little bit smaller, because we probably will export more DDGs and other things that that can provide the protein content in meal rations. However, I think that there is going to be an increase to the point that it's going to depress world meal prices, and so that will reduce Argentine crush margins. But if the world needs soybean oil, then soybean oil prices in Argentina will need to rise enough to incentivize Argentine crushers to crush. And so you could see oil share in Argentina do something similar, not as drastic as I think in the US, but something similar to what we expect in the US. That's in the short term. In the longer term, while that trend may continue, I still think that the loss in margin on the meal side probably means that Argentine margins in the long run are going to be depressed by some amount. I don't know that I think it will be as bad as I probably thought it would be 6 months ago. But I do think that that the Argentine crush industry is going to go through a rough patch here. The other thing that I kind of wanted to point out is the Chinese crush demand, and you can see there's significant growth built into our forecast, or maybe not significant growth, maybe a little bit of growth built into our crush forecast. And so I think if you look at and pay attention to Chinese crushing margins, then again, you'll get a sense of whether the actual crush will be close to our forecast or it will be lower. And then that gives you some sense of how important the weather is going to be in Brazil and Argentina. Again, it's going to be very important. It's just, again, it's a question of, is it so important that we have a shot at record prices, or is it just important enough to support prices at the upper end of the historical range if production is a little bit lower than expected? The last point I really want to make on crush is that we get the fats and oils report on Thursday, and if you look at the U.S. crush in September, and then the total that's implied by the NOPA data for October, there hasn't been a huge increase year over year in U.S. crushing volumes in those 2 months. And so given the fact that I expect a big increase year over year for the marketing year, that means that each passing month where we don't get that increase either means that I need to lower my marketing year total, or I need to pack more of the crush into the back end of the year. And that's kind of what I've done right now. And almost no matter what the fats and oils report says, that's probably where I'm going to stick, at least until we get the NOPA data in November. However, if the NOPA data in November suggests a similar rate of year over year growth, then I'm probably going to need to start to cut my my forecast. Now, there's a little ways to go. I've got some room to cut before I get to where USDA is. And so if we look here, oh, this is soybean oil. So like I said, I've probably got 40 or 50 million bushels that I can cut out of my forecast before I get down to where USDA is. And if you spread that out over 10 months, that's significant. But I've already got increases in some months of maybe 10 million bushels. And so that would imply on average a 4 million bushel a month cut. And so you can see, even if I take 4 million bushels out, that still implies a relatively big year over year increase over the remaining months. And so again, if we don't get that with the November data, I'm going to start cutting. But it may be that that USDA and other analysts also start to cut their crush forecast. That's important because, one, theoretically, it frees up a little bit of supply that could be exported to China if their crush margins are going to be high, and Chinese import demand is going to be strong. Two, it means that Argentine meal prices probably won't be under as much pressure, and so Argentine margins will be better. But three, and most importantly to this call, is that it will reduce the soybean oil supply. And if it reduces the soybean oil supply, you can see, based on our assumptions, we don't have that far to go before we start to cut into ending stocks and get ending stocks down to a level where again, soybean oil prices may trade in the upper end of the historical range, which is 75 or 80 cents at this point, or may move well beyond that, just kind of depending on one, what biofuel profitability looks like, the demand for vegetable oils for non-biofuel, and the availability of substitutes for soybean oil, either canola oil for the food industry or palm oil for the feed industry. And so the next month or two, the crush data for the next month or two is going to be really important for the U.S., at least from my perspective, to give an indication of where we're going to be for the marketing year, and then what that implies for the soybean oil balance sheet. All right, so we didn't really change our forecast that much this week. Didn't change them at all, actually. As soybean oil prices remain in our range, they kind of, over the last 2 weeks, they kind of dropped the first week and then came back the second week. And so if you look at where we were the last time we talked versus where we were yesterday at the close, we're actually a little bit below that. And so we didn't really feel the need to change our forecast. I think that, again, there's probably about 1 more month or so of the potential for higher prices, and then we start to get into early Brazilian harvest. We also start to know a lot more about what we think the South American production is going to be, assuming that we get a relatively normal, or the South American crop meets expectations. Then I think the forecast that you see holds. If we don't get that, then this forecast is going to change, and it's going to reflect higher prices. Probably, at least initially, what would happen is the sort of the equilibrium price would probably rise from 65 cents to 70 or 75 cents, depending on exactly what happens, and then kind of go from there. Again, depending on exactly what the South American crop looks like, how strong non-biofuel demand is in the U.S., and what the U.S. crush is doing. For canola oil, we got the monthly canola crush from COPA last week, and it came in. It's a little bit like the U.S. crush, where it certainly has bounced back from last year's drought-reduced crushing volumes, but we haven't seen a big jump, and we haven't seen an increase from 2 years ago, which was the record. Now, 2 years ago, Canadian crushers were crushing canola at just about full capacity, and so maybe right now it doesn't make a lot of sense to assume that there's going to be a big increase in Canadian canola crushing, because they're close to full capacity. They're going to expand their capacity, and so that will change. And we're not predicting a huge jump from the record levels that we saw a couple years ago. In fact, I think we're pretty close to the same. But this year's crushing volumes are not meeting the volumes that we saw 2 years ago, and so there's some downside risk on Canadian canola crushing. Now, I think that as we move through the year, that much like the U.S., I think that the demand for vegetable oil and vegetable oil prices has the potential to be stronger, and that would encourage an increase in canola crushing, and that would support something that may ultimately end up with a crush that is close to our 10.35 million ton forecast. However, we're kind of in the same spot with Canadian canola, where if the next month or two we don't see kind of an acceleration in crushing volumes, we're probably going to start to cut our crush forecast a little bit. For Canadian canola, it's easy to offset that with increases in exports. You can see we've got exports at 8.1 million tons, a little bit above USDA, well above where we were last year, but also well below where we were in 2021. And so there's room to increase exports, particularly if Chinese crush margins remain in the upper end of the historical range. They will be happy to import Canadian canola seed and crush that in China to provide canola oil and canola meal. And so even if I do cut the crush forecast a little bit, I'll just offset it with an increase in Canadian exports. Now, the thing about the COPA crush numbers, somebody asked me, I don't know, a couple of weeks ago, maybe a month ago at this point, when we would see a recovery in the oil yield. And this month we didn't see that recovery. Now, typically you start to see sort of the switch from old crop to new crop in the September numbers. And now we're through September and into October, and in October the yield actually went down from September. And so it looks like we're probably, especially given the fact that the prior year they had the drought, and so it's not like there's a bunch of the old crop hanging out waiting to be crushed. They probably worked through the old crop, and if anything, the transition to the new crop was probably faster this year than it is in most years, which suggests that that the oil yield for 22-23 could remain closer to where we were last year, which is kind of around 41, just under 42%, someplace in there, 41.5 or 41.7, someplace in there. Then the year before, which I think was a little bit over 43%, certainly well over, maybe it was 42.9 or 42.7, something like that, but well above where we're going to be. It won't make a huge difference in the supply and demand, unless, again, if U.S. biofuel demand is going to be really strong, and let's just say that U.S. crush isn't quite as strong as we're predicting, and U.S. non-biofuel demand is equal to or greater than it was last year, then we're probably going to need some canola oil imports to help with that, the strength of that non-biofuel demand. And in that case, then I think you could see a situation where Canadian exports are a little bit stronger than we're expecting, and then I would also expect that, again, during sort of the second half of the year, you get Canadian crushing volume, monthly crushing volumes that offset sort of the smaller, not year over year, but year over 2 years ago change in crushing that we've seen during the first couple months of the marketing year. For palm oil, there was an announcement last week by the Indonesian president, suggesting that he was going to change the ratio on the domestic market obligations, cut it essentially from 9-to-1 to 5-to-1, which would free up more palm oil for Indonesia to export. That would make Indonesian palm oil more competitive and tend to weigh on Malaysian palm oil exports. Right now, it looks like Malaysian palm oil production might be a little bit stronger than I think we're kind of assuming. And kind of what I wrote about this week is that while we've got a relatively small decrease, month over month decrease for November from October. Once we get into December and January, then we've got pretty big increases, sort of like 12–13% a month decreases in production built into our forecast. And so if production is a little bit stronger and Indonesian exports are a little bit more competitive, then you could see a situation where Malaysian ending stocks are a little bit higher than we're projecting. So we're at 2.25 million tons right now. If production's closer to, call it 19 million tons, and exports are closer to 16.5, let's just call it, or 16.45, just to make the math easier. There isn't, maybe you offset a little bit of import demand, but the rest of that just is going to go straight to the carryout or straight to ending stocks. And that will weigh on palm oil prices. We've got palm oil prices, as you can see, kind of flat through the year, on this idea that the spread between soybean oil and palm oil will kind of narrow as we move forward through the year. We've seen the spread over the last couple of weeks. The December contract, the spread peaked at 38 cents and then has come back down under 34 cents, I think. So in theory, maybe that's happening, but markets don't go straight up, and this may just be another little setback, and then we'll go back up. I've got to believe that we're close to the theoretical maximum, but in that spread. But I've believed that for the last 10 cents at least, maybe 15 cents, and so take that for what it's worth. But I think if we do get that situation where production is stronger than expected and exports are a little bit weaker than expected, we probably will find out what that maximum ultimately is. All right, let's talk about biodiesel. So this week, I finally got to process the EMTS data. I'm still having problems with the EMTS, with the EPA's website. So I finally got that data in, and if you look at in production came in mostly in line with our expectations. So there really isn't that much. There wasn't that much that was different. Domestic renewable diesel production was a little bit weaker than we expected, but that was mostly offset by stronger foreign generation on the renewable diesel side. On the biodiesel side, we were 1 million gallons off, or a little bit more than 1 million gallons off on domestic production, and we were 1 million gallons in the opposite way off on import. So combined, we were off by 500,000 gallons. And so that doesn't imply that we needed to make big changes in our forecast for domestic production. However, based on production in some of the other categories, if you think about the two gaps that biomass-based diesel typically fills, which are the gap between ethanol production and the ethanol mandate, which again this year is unusually large, and then the undifferentiated advanced gap, or basically the difference between the advanced mandate and then the sum of D5, D4, and D3 production. Whatever that gap is also generally filled by biomass-based diesel. Because production in other categories, including ethanol, was stronger than we anticipated, and in fact, we actually raised our forecast for ethanol production by 250 million gallons based on the total for October. That reduced both of those gaps. And so it cut our forecast for domestic renewable diesel production by 40 million gallons. And it cut our forecast for biodiesel production by 47 million gallons. Now, I've left those unchanged this week just to kind of show. And let's see if I can get the right chart here. That's the wrong one. So this is December, and you can see in December we've got just a little increase, basically 1 million gallons in our biodiesel production, and I don't know, I guess a 2 million gallon increase in our we've actually got a 11 million gallon decrease in renewable diesel. That's obviously the opposite of the usual trend. And in addition to that, if you look at this chart, which I know is a busy chart and not a great way to represent this, but if you look at this December number, what this shows is it tries to say, okay, what's the profitability of biodiesel production? So RIN prices minus the HOBO spread, since the HOBO spread is the reverse of profitability, versus the excess biodiesel supply. So domestic production and imports relative to the 5-year average. And you can see this is not, again, it's not the tightest relationship in the world, but it does do a decent job of indicating the trend. However, you can see that for December, we are essentially predicting that biomass-based diesel production will be profitable, which means in most months, except for December 2 years ago, that you would get production that was maybe down a little bit from the 5-year average or maybe above the 5-year average. But right now, just based on the reduction in those two gaps, we're saying 60 million gallons below the 5-year average. So I left that unchanged this week to kind of show the difference in the gap based on the larger than expected production in the other categories. But I'm going to go back, and for next week's report, I'll make the changes that I think make sense based on the typical seasonal pattern and the economics of production during the last 2 months of the year, and change this. But I did kind of want to show how production in other areas can have some impact, even if it's not as strong as it would be if you just kind of took the numbers straight. But I wanted to show how that change in those gaps can have an impact on at least people's expectations for biomass-based diesel production. All right, for gross margins this week, over the last 2 weeks, we've seen kind of a decline in the renewable diesel margin, and then we saw a drop and then a bounce back in the biodiesel margin. So biodiesel rose up to just over $1, and then drops back down this past week to 99 cents from 98 cents a couple weeks ago. Conversely, renewable diesel dropped from 240 to this thing is so small. Let's try this. from, I guess, 260 to 240 and then 239 this week. Don't know why that looks like that's actually going forward. And the main difference in the profitability during that time has been different movements in the fuel prices. Essentially, if you look at the price of renewable diesel, that has gone basically straight down, and if you look at the price of biodiesel, it kind of followed the margins, where it sort of went up the first week and then last week it went down. Biodiesel without credits. And so that explained most of the difference in the prices. This isn't a week where we say, well, the biodiesel reflects the using soybean oil as a feedstock, and renewable diesel reflects using fats and greases as feedstocks. This is really just about the price of fuel. And so the market, at least right now, is telling renewable diesel producers that it has enough, and they are more closely aligned with what we've seen in the broader energy markets. Those prices are than biodiesel. Surprisingly, biodiesel is kind of hanging in there, and the market is telling it that it's okay at current levels, or maybe even wants a little bit more biodiesel. I honestly don't have a great answer as to why that is, but what I will say is that for November, what that shift implies is that the average price of biodiesel is going to be above the average price of renewable diesel for November, which is something that we don't see that often. Our forecast going forward assume that we will return to the average spread, which over the past 12 months has been about 23 cents. And so our forecast going forward for renewable diesel may be a little bit optimistic, although we've got renewable diesel kind of coming down, or maybe recovering a little bit, but not that much from current levels. And we've got biodiesel kind of coming down relative to renewable diesel. So if that trend is going to continue, then in all likelihood, I would say that our biodiesel price forecast is probably a little bit pessimistic. And we'll see what happens over the next couple of weeks. If the trend kind of continues and biodiesel prices kind of continue to hang in there, which they have been for a little while already, but if they kind of continue to hang in there, then I probably will start to change my forecast at least through the end of the year, so that that spread is a little bit more narrow, or potentially even reflects the premium for biodiesel relative to renewable diesel. I can't imagine that that's going to last in the long term, but there may be, at least again through the end of the year, there may be a reason, and I will try and dig and find out what the reason is. But the reason that is happening right now, it's just really unusual that you see that, and again, not something that I would expect will persist, but it may, and again, it may be a reason. There may be some of the state level requirements for biodiesel may be the reason behind the higher biodiesel prices. For the RIN forecast, the models really wanted to go crazy this week, and I really didn't adjust them that much. So I think the only adjustment I made from the model suggestion this week was a small decrease in the D4 price for December. And other than that, I kind of let them go. And they kind of suggest that by the end of next year, based on our forecast for fuel prices and for feedstock values, that the RIN prices will need to do some work to offset a decline in margins. And The reason for that, if we look at our forward curve, if you look, last month is green where we were last month versus where we were, I guess, last week and where we are now. Even though we kind of may have topped out, at least in the short term, last week, this week is still well above where we were sort of a month ago. And that's really what is driving the continued strength in RIN prices, and also the model to forecast RIN prices higher out going forward. For the LCFS credit price, I did make a slight change to the forecast this week. Prices have kind of bottomed out around 60, between 60 and 65, or maybe around 65. And while, again, in the past, I've said, okay, there's been bounces, those haven't tended to last as long as this one has. And while I still think that the marginal cost of shipping, which is what kind of should dictate the LCFS credit price, is around $50, there needs to be some profit in there. And so I raised the forecast by about $5. So the low now here, I think it got down to 55 maybe, or maybe it even took it down to 50 at some point next year. I raised that up so that we're kind of around 60. Of course, now that I've raised it, RIN prices will continue to move lower, resume the trend lower, but at least in the short term, that's where we are. All right, with that, if anybody has any questions, I'm happy to answer them. If not, I'll get you out of here only 9 minutes late this week. And all right, unless anybody's typing furiously, we will wrap it up. Thank you so much for attending this week. If you do have questions during the week, please always feel free to reach out to me, send me an email. I try to get back to them as quickly as I can. Sometimes it takes me a little longer than I want it to, but please always feel free to reach out. Other than that, thank you for coming, and I will see everybody next week. Have a great week, everybody.